Today, we will talk about the January effect in the stock market. The January effect is a perceived seasonal increase in stock prices during the month of January. Analysts generally attribute this rally to an increase in buying, which follows the drop in price that typically happens in December when investors, engaging in tax loss harvesting to offset realized capital gains, prompt a sell-off. Another possible explanation is that investors use year-end cash bonuses to purchase investments the following month. While this market anomaly has been identified in the past, the January effect seems to have largely disappeared as its presence became widely known. Traders should be aware of the tenuous nature of the January effect and instead focus on the market conditions at the time and what they suggest for the overall short-term direction of the SPDR S&P 500 ETF. The January effect is a hypothesis, and suggests that small caps are more affected than mid-caps or large caps. Since the beginning of the 20th century, the data suggests that these asset classes have outperformed the overall market in January, especially toward the middle of the month. Another reason analysts consider the January effect less important as of 2022 is that more people are using tax-sheltered retirement plans and therefore have no reason to sell at the end of the year for a tax loss. Beyond tax loss harvesting and repurchases, as well as investors putting cash bonuses into the market, another explanation for the January effect has to do with investor psychology. Some investors believe that January is the best month to begin an investment program or perhaps are following through on a New Year's resolution to begin investing for the future. On a large scale, year-end sell-offs also attract buyers interested in the lower prices, knowing that the dips are not based on company fundamentals, which can drive prices higher in January. An ex-director from the Vanguard Group, Burton Malkiel, the author of A Random Walk Down Wall Street, has criticized the January effect, stating that such seasonal anomalies don't provide investors with any reliable opportunities. He also suggests that the January effect is so small that the transaction costs needed to exploit it essentially make it unprofitable. Other researchers have found that January effect still exists, but only for smaller cap stocks, owing to a lack of liquidity and interest from investors. The January effect is a purported market anomaly whereby stock prices regularly tend to rise in the first month of the year. Actual evidence of the January effect is small, with many scholars arguing that it does not really exist. Indeed, a look back over the past 30 years, since the inception of the S&P 500 ETF, shows only 17 winning months versus 13 losing months, or a 57 to 43% split, i.e., not much better than the flip of a coin. Here are 5 key takeaways. 1. The January effect is a perceived seasonal tendency for stocks to rise in that month. 2. In the bigger picture, since 1938, 29 out of 30 years of gains seen in January-February resulted in average yearly S&P 500 advances of 20%. 3. The January effect is theorized to occur when investors sell losers in December for tax loss harvesting, only to rebuy new positions in January. 4. Like other market anomalies and calendar effects, the January effect is considered by some to be evidence against the efficient markets hypothesis. 5. Over the past 30 years, January gains have occurred 17 times, 57%, while losing January months numbered 13, 43%, barely better than the flip of a coin. Hope this would help. Thanks for watching.